Welcome back. This is Unit 1, Part 2 of our Introduction to Financial Accounting. In this video lesson, we're going to take a look at what I consider to be one of the fundamental building blocks of any accounting system, that being the chart of accounts. And there's 5 types of accounts which we're going to look at, and that's why I've called it the Legend of the 5 Types. So what is the chart of accounts? It's a list of accounts used in the accounting system. And so for any transaction that we will record or make journal entries for, it must come from this list of accounts. There's a standard general format that I will explain in a few minutes, but also though, there's detailed subcategories that is specific to each and every business, meaning that each and every business has a unique chart of accounts. And this chart of accounts is private and confidential. Now, what is the legend of the 5 types of accounts? I'm going to start off with the first 3. And the first 3 are known as assets, liabilities, and equity. These 3 accounts make up what is known as the balance sheet. This is an example of a financial statement, and it's called a balance sheet. I'll talk about the role and function and format of a balance sheet a little bit later. The final 2 charts of account are known as revenues and expenses. And these 2 items go into the creation of the company's income statement. And so what I'd like to do now is I'd like to look at each of these accounts in more detail, and I'll talk a little bit about each of them. So let's start off with assets then. Assets are resources with an economic value that the business owns and is expected to provide future benefit. There's 2 types of assets that exist for any organization. The first category is known as current assets. Current assets are those resources that you're able to turn into cash within 1 year. I've given you some examples: cash, accounts receivable, which I will talk about in a minute, prepaid expenses, and also any inventories that you might that the company might hold. Now, I want to explain one concept here, and that is that sales for many businesses may not result in cash right away. Wholesale transactions, they're often on credit terms, meaning the common credit terms in Canada is 30 days. So you deliver your goods one day, you get payment 30 days later. Also, service contracts, they're not paid when signed. And so therefore, you might sign a contract with another organization, but you will not receive payment for that for until future periods. That creates an asset known as an account receivable. And so accounts receivable are items for which you have delivered the service, but you have not received in cash. And so it's really important to understand that accounts receivable is not cash. The other category of assets is long-term assets. The general definition of that, it's expected to provide future benefit for more than 1 year. I've got some examples of that: buildings, vehicles, equipment, and specifically computer equipment in this case. So you might see in your chart of accounts individual categories for each of those long-term assets. One characteristic of these long-term assets is that we cannot charge the cost of long-term assets in the year that they were purchased. So we buy a building for several $1,000,000. We cannot expense that building in the year that we have purchased it. We must expense the asset, generally speaking, over the useful life of that asset. And so it creates an expense, which I will get to later on, called depreciation. And the longer term that I will use is depreciation, depletion, and amortization. Those are all forms of depreciation for different types of assets. Now let's move on to liabilities. Liabilities are resources with an economic value that the business owes to other stakeholders. So these are, in a sense, debts. The first category of that is current liabilities, any expenses that the business expects to pay within 1 year. And I've just listed out a few categories of accounts of current liabilities. Accounts payable is probably the most common example of a current liability. And these are simply payments that we owe to our suppliers. We've received the benefit of that good or service, but we have not yet paid. And so we will record that as an account payable. We'll get to the other ones a little bit later on in the course. The other category of liabilities is known as a long-term liability. The business expects to repay these liabilities over more than 1 year. The two main examples of that is bank debt. So if you take out a bank loan, you normally will repay it over roughly 5 to 7 years approximately. So that therefore it's a long-term liability, and also long-term bonds as well. We'll get to how we treat the accounting for long-term liabilities later on in the IFA course. Let's move on then to equity. Equity is the shareholder's share in the business. And so this is the owner's portion of the business. There are three main categories that we will use in the equity account. First is shareholders' equity, which represents the initial investment by the owners of the business. Depending on whether the company is a sole proprietor or a corporation, we might use different names for this category, but it essentially means the same thing. So if we're dealing with a sole proprietor, we would call it owner's equity. With a corporation, we call it shareholders' equity. The second category is called retained earnings. This is actually my definition of retained earnings, and I hope this still applies. I describe it as the cumulative profits of the business, less dividends paid to shareholders. And so that's what the retained earnings account will record, is all the profits from the very beginning of the corporation, less any dividends that were paid out to shareholders. And then the last category then is dividends. Dividends are paid out of retained earnings, and I'm going to repeat that a few times in this course. It is not an expense. These are payments made to the owners of the business. And as I mentioned before, if we're dealing with a sole proprietor, we have the same three categories, but we might give them different names. Instead of shareholders' equity, we would call it owner's equity. Instead of dividends, we would call it withdrawals, or sometimes your textbook will call it drawings as well. So those are the balance sheet accounts that will go into the accounting system. Now let's take a look at the income statement accounts. What is revenue? Revenue, income generated by the sale of goods and services related to the company's main operations. And there's an emphasis on the company's main operations as well. For a merchandising firm, a business that sells goods like a supermarket or a general store like Walmart, or a manufacturer, some business that produces goods, we will recognize product sales. And so we'll have different categories of revenue for product sales. For a service company, an accounting firm or a consulting firm, we would recognize service revenue. In the example that I have coming up for SoftBite SA, they're a high-tech consulting firm, so we would recognize service revenue. And then there are other categories of income. These are other types of income which is not part of the company's main line of business. And so this can include interest income from short-term investments, gains and losses from the sale of long-term assets as well. And finally then, what are expenses? Expenses are costs incurred to generate revenue. Any other costs are not expenses. So if we did not incur the cost to generate revenue, then we should not be including it in our financial statements. And as I said, personal expenses should not be included in the business's income reports. If you are a merchandiser, you sell goods like Walmart, or if you are a manufacturer, then we will have a category of expenses called cost of goods sold. And once again, in the IFA course, there's a separate chapter to talk about merchandising firms and how we do accounting for them. But they would have different categories: direct materials, direct labor, direct overhead. A service company would not have these categories. Service businesses, though, they may want to record direct labor hours attributable to specific clients or lines of businesses. And so they may want to set up their accounting system so they can identify for each client that they have how many hours they spent to provide service for them. Or if they have multiple lines of businesses, different consulting type activities, they may want to keep their labor hours separate. Now, for both merchandising companies, manufacturers, as well as service companies, all three of those types of businesses will have what is known as operating costs, costs that cannot be directly associated with a unit of sales. And so this can include management expenses, management salaries, office rent, advertising and promotion, legal expenses, and also accounting expenses. Depreciation expense I will get to again a little bit later on. It's related to long-term assets and also bank charges as well. So now then, I've given you a really brief introduction to the 5 different accounts that go into the chart of accounts. So now what? What do we do now? Let's talk about the specific chart. And so first off then, there's a standard format for the chart of accounts. And that standard format is the order in which we list our accounts. And it's always assets, liabilities, equity, revenue, and expenses. And that's standard for all charts of accounts. And this is the standard part of the asset. You can see here that I've assigned numbers to each of these categories of accounts. So all assets that we have in our chart of accounts, they're going to start with 1,000 something. And so as long as we see an account that has a number related to 1,000, we know that it's an asset account. And the same goes for liabilities. All liabilities will be listed as the number 2,000. All equity accounts, 3,000. Revenue, 4,000. Expenses, 5,000. So that's the numbering system. And as I said, this is fairly standard for all charts of account. What comes next, though, is the detailed chart of accounts. And you can see here that I've expanded each category. And this is where I've said that every business will have a unique chart of accounts. No two businesses are the same. Therefore, no two businesses will have exactly the same chart of accounts. And this is where you, as an emerging accountant, will be able to specify exactly what kind of categories or accounts does this accounting system require. You can see here that all asset accounts, cash, accounts receivable, supplies, equipment, they all start with the number 1,000. Cash, 1,010, all the way down to equipment, 1,040. There are gaps between the numbers, and I've done that on purpose because it is allowable to expand. You should try to avoid expanding your chart of accounts too often because it just adds confusion to your accounting system, but you can expand your chart of accounts. And you'll get to the point where this chart of accounts will apply to all lines of businesses that the company runs. And at that point, the chart of accounts should never change at that point. So that's our chart of accounts. And so when we start analyzing transactions, All accounts that we use, whether we debit cash or credit revenue, all of those accounts must come from our chart of accounts. Finally then, just to summarize, the order of the chart of accounts is standard, but the actual accounts is unique to each business and it is private and confidential. And also too, the accounts you choose when you make journal entries into your accounting system, they must come from your chart of accounts. So now we have an understanding of the basic foundation of an accounting system and how it is structured. And now let's start taking a look at financial transactions, which we will start in our next video. We will see you then.